How does generative AI simulate market scenarios in finance? Imagine being able to see into the future of financial markets without actually risking your money. That's what generative artificial intelligence can do. It creates realistic simulations of how markets might behave under different conditions. This technology is transforming how banks, investment firms, and regulators understand risks and plan for the future. Generative AI works by learning from huge amounts of historical market data. It looks at prices, trading volumes, economic indicators, and even news reports and social media chatter. By analyzing these patterns, it can understand how markets react to various events. Then, it uses that knowledge to produce new data that mimics real market movements. These synthetic data sets include potential future scenarios, even those that have never happened before. One common method is using models called generative adversarial networks. These models have two parts. One creates fake data, and the other checks if it looks real. They keep working together until the generated data looks just like actual market data. Another approach uses transformer-based models, similar to the technology behind ChatGPT, which can understand and generate complex sequences of data. These models can simulate how markets might respond to economic shocks, policy changes, or sudden investor shifts. The process begins with the AI ingesting structured data like stock prices and economic reports, along with unstructured data like news articles and social media posts. It learns the relationships between different factors and how they influence market movements. Once trained, it generates new data sequences that representing possible future states of the market. These sequences can include rare or extreme events, which are often hard to predict with traditional methods. Financial institutions then use these synthetic scenarios to test their strategies. For example, they can see how a portfolio might perform during a recession or a sudden market crash. They can also simulate how changes in regulations or interest rates could impact their investments. This helps them identify vulnerabilities and improve risk management. In credit risk modeling, generative AI can simulate borrower behavior under different economic conditions. Banks can better assess the likelihood of loan defaults during downturns. Fraud detection systems benefit too, as they can be trained on synthetic transaction data that includes fake or suspicious activity. Regulators use these simulations to ensure financial products meet new standards and are resilient to shocks. The ethical side of using generative AI involves making sure the data is private and that the models are transparent. It's important to avoid bias and ensure the simulations are fair and accurate. Proper oversight helps prevent misuse or unintended consequences. In essence, generative AI acts like a crystal ball for finance. It produces realistic market scenarios that help professionals make smarter, more informed decisions. By creating detailed simulations of future possibilities, it allows the financial world to prepare better for whatever lies ahead. This technology complements other AI tools like ChatGPT and productivity plugins, making financial analysis faster, clearer, and more reliable.